Okay, welcome everyone to the deep dive.
Great to be here.
And this particular deep dive, it was actually requested by Noah from Atlanta, Georgia.
Oh, fantastic.
Yeah, and we're really excited to tackle this one because, Noah, you mentioned you've been, navigating the crypto world for about 2 years now.
2 years, wow.
So this is officially Season 2, Episode 11.
Right, and we're calling this Season 2, Blockchain Blueprint. Cryptocurrencies, digital assets, and more.
Catchy.
Yeah.
It's all about building that solid foundation, isn't it?
Precisely. And for this journey, we've got an amazing guide. This deep dive was produced by Katie St. Ors.
Ah, Katie.
Yeah, she's a digital asset tax specialist. And the source material we're really leaning on today, it's a beginner's guide she actually wrote.
Oh, brilliant.
Yeah, leveraging all her expertise as a certified financial planner. And she's also an enrolled agent who specializes in digital asset tax.
So really knows her stuff.
Okay, so perfect credentials for this. So for you, Noah, and really anyone listening who's curious, our mission today is to use these insights from Katie's guide to, well, demystify these core ideas.
Like cryptocurrency, blockchain.
And that whole expanding universe of digital assets. So we're going to explore the basic tech, look at the different ways this digital value, shows up.
And importantly, get into the practical side of things, the risks, how you keep things secure, and yeah, the taxes. Always the taxes.
Always the taxes. It's a space that can feel pretty overwhelming.
Oh, absolutely. But when you start breaking it down, you find these concepts that are honestly quite revolutionary. They promise to change how we think about value, ownership, even trust itself.
Totally. So you've been trading, Noah, you've seen transactions, maybe wrestled with a wallet or two, but what's the fundamental engine making it all work?
It really starts with the bedrock, doesn't it? Blockchain.
Exactly. To understand why crypto and all these other digital assets behave the way they do, you really have to get your head around blockchain first. The source material, Katie's guide, uses a great analogy.
Okay.
Picture a ledger, right? A record book. But instead of it sitting in one bank vault, controlled by one company.
It's like that ledger is copied like thousands, maybe millions of times, and spread across computers all over the world.
That's the key. Everyone has a copy, and sort of everyone helps maintain it.
Right.
And that distribution, that's the core of its first big revolutionary property. Decentralization. Meaning there's no central bank, no single company, no government that's ultimately in charge. It's run by the collective network of participants.
And why is that such a big deal?
Well, think about it. It removes single points of failure. If one computer goes offline or one company goes bust,
the network keeps going.
Precisely. It makes the system incredibly resilient, resistant to censorship, resistant to shutdown. It's a fundamental shift away from, the traditional centralized systems we rely on for everything.
That is pretty mind-bending when you first think about it. Okay, so decentralization is key. What's the next core characteristic?
Immutability. Fancy word. But it just means that once a transaction is recorded on the blockchain, changing it or deleting it is, well, it's practically impossible.
Well, that's where the chain part comes in, right? The blocks of transactions are linked cryptographically.
Exactly right.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Each new block of transactions contains a cryptographic link, like a digital fingerprint, to the block before it. So they form a chain.
Okay.
To alter an old transaction, you wouldn't just have to rewrite its block. You'd have to rewrite every single block that came after it, all across the entire network, basically simultaneously.
Which would take an insane amount of computing power.
An astronomical amount.
Yeah.
So it creates this permanent, tamper-evident history. You can trust the record because it's so hard to cheat.
Okay, so it's decentralized, can't be changed easily. What about seeing what's actually on this shared ledger?
Good question. That brings us to transparency, but often with pseudonymity.
Explain that.
Well, the transactions themselves, the movement of assets from one address to another, are typically public. Anyone can look at the blockchain explorer and see them. That's the transparency. But the identities of the people controlling those addresses are usually hidden behind these long strings of letters and numbers, the digital addresses. That's the pseudonymity.
Ah, okay. So you can see address A sent X amount to address B on Tuesday, but you don't automatically know who owns address A or address B unless they link it to their real identity somewhere else.
Exactly. This allows for public verification. Everyone can see the transaction happened without needing a middleman like a bank and without revealing everyone's real-world identity for every transaction. It builds trust in a different way.
Got it. And the last key property, you mentioned crypto.
Security. It all relies heavily on cryptography. That's the crypto in cryptocurrency. These cryptographic techniques are used to link the blocks, secure the network, and verify the transactions. It makes the ledger itself highly resistant to fraud.
Okay, so let's boil that down. Blockchain is like a shared public spreadsheet or record book.
Yeah, a good way to think about it.
That's copied everywhere, incredibly secure, almost impossible to tamper with after the fact, and it's maintained by everyone involved, not one boss.
You nailed it. It's not just a database. It's really a new mechanism for establishing trust and recording value digitally. It's the foundational piece.
It really is. Okay, so that's the engine. Now, let's talk about the most famous application, the one Noah's likely been dealing with for 2 years. What exactly is cryptocurrency in this blockchain context?
Right. So cryptocurrency is basically digital or virtual money. Yeah. It uses that cryptography we mentioned for security, and it operates on top of a blockchain.
And just like the blockchain itself, it's decentralized money.
Correct. It's not typically issued or controlled by a central bank like the Federal Reserve or the Bank of England. Its rules, how much exists, how transactions work, how they're verified, are all built into the blockchain's code, the protocol, and managed by that distributed network.
Which allows for those direct peer-to-peer digital transactions we hear about, sending value straight to someone else online without needing a bank in the middle.
Exactly. That's one of the big promises, potentially faster, cheaper transactions, especially across borders, because you're bypassing the traditional financial plumbing.
Okay, but how does new crypto get created? Or how do we know those transactions are valid if there's no bank checking them?
That's where mining or validation comes in. These are the consensus mechanisms.
Right.
For Bitcoin, the most famous is mining. Computers on the network basically race to solve complex mathematical puzzles. The winner gets to add the next block of transactions to the chain and is rewarded with newly created Bitcoin.
Okay, so that's how new Bitcoin enters circulation.
Yes, and it also validates the transactions in that block. Other systems, like newer versions of Ethereum, use staking. Here, participants lock up some of their existing crypto as collateral.
Like putting down a deposit.
Sort of, yeah, to get the right to validate transactions. If they act honestly, they get rewards. If they try to cheat, they can lose their staked crypto. Both methods incentivize participants to maintain the network's security and integrity.
Got it. So miners or validators are keeping the ledger accurate. Now, the big examples Noah's definitely encountered.
Well, the source highlights the giants, of course. First up, Bitcoin, BTC.
The original.
The OG. It really pioneered the whole concept. It's often talked about as digital gold, partly because of its program scarcity. There will only ever be 21 million Bitcoin created.
A hard cap.
Yeah.
Interesting. Then the other huge one, Ethereum, ETH.
Ethereum is massively important. Yes, it's a cryptocurrency you can buy and sell, but it's much more than that. It's also a platform. Yeah, its blockchain is designed to be programmable. Developers can build complex applications called decentralized applications or dApps, and automated programs called smart contracts right onto the Ethereum blockchain.
Smart contracts, like self-executing agreements.
Exactly. Code that runs on the blockchain and automatically executes the terms of an agreement when certain conditions are met. Think vending machine, but for complex digital agreements. Because of this programmability, many of the other digital assets we'll talk about are actually built on Ethereum.
So Ethereum is less like digital gold and more like a decentralized world computer or operating system.
That's a really good analogy, yeah. It powers a huge part of the ecosystem. And then beyond those two, there's just this vast ocean of altcoins.
Everything else.
Literally everything else. Thousands of them. Things like Solana, Cardano, Dogecoin, you name it. Each one is usually trying to do something slightly different, maybe be faster or more private or tailored for a specific use case.
Okay, so crypto is digital money running on these blockchains, but you mentioned the term digital assets is broader. What else fits under that umbrella that someone like Noah might come across?
Right. Digital assets is the wider category. It includes cryptocurrencies, sure, but also any other kind of property that's represented digitally and secured using blockchain tech.
And one type that absolutely blew up in the headlines, non-fungible tokens, NFTs.
Yes, NFTs.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
The key word here, especially for someone like Noah used to crypto, is non-fungible.
Meaning not interchangeable.
Exactly. One Bitcoin is the same as any other Bitcoin. They're fungible. But an NFT is unique. It's a one-of-a-kind digital token on a blockchain that represents ownership of a specific item.
Like a digital certificate of authenticity or a deed for something digital.
Precisely. They provide verifiable proof recorded on the blockchain that you own this specific digital artwork or this specific piece of music or virtual land in a game or even a token representing a real-world object. They tackle that problem of proving ownership and scarcity for things that exist purely digitally.
Interesting. Okay, what about DeFi tokens? Decentralized finance sounds ambitious.
It is ambitious. DeFi tokens are essentially the components or fuel for those dApps we mentioned, specifically ones built to recreate traditional financial services.
Like lending, borrowing, trading.
Exactly. Lending, borrowing, exchanges, insurance. But the aim is to do it directly on the blockchain, without the traditional banks, brokers, or insurance companies acting as intermediaries.
So finance run by code on the blockchain.
That's the core idea. These DeFi tokens often have specific roles within these applications, maybe giving holders voting rights on how the app is run, governance, or you stake them to earn interest, yield, or use them as collateral for loans. Think of tokens associated with platforms like Uniswap, UNI, or Aave, AVE.
Okay, so it promises more open, maybe more efficient finance.
That's the promise, yes. More accessible, transparent finance. However, and this is really important, the source material strongly emphasizes this. DeFi also comes with significant and unique risks. It's complex, it's new, things can go wrong fast. High potential reward, but definitely high potential risk.
Understood. High risk. Then there's this term, Web3 assets. This is tied to the whole idea of a new internet, right?
Yeah, Web3 is this concept of the sort of next evolution of the internet. The idea is to move away from the current internet dominated by a few large centralized companies.
Like Google, Meta, Amazon.
Right. And instead, build services and applications on decentralized infrastructure, primarily blockchains. The goal is to give users more control over their own data, their digital identity, and their online interactions.
So Web3 assets could be things like tokens representing your decentralized ID or ownership in an online community or virtual items in a metaverse.
Exactly, those kinds of things. It represents a potential shift towards a more user-owned, user-controlled internet. Still very early days, though.
Seems like a theme here. And finally, one more category the source mentions, stablecoins. These sound different, designed not to be volatile.
That's their entire reason for existing, yeah. Stablecoins are a type of cryptocurrency specifically designed to maintain a stable value. Usually, they achieve this by being pegged, often one-to-one, to a traditional asset.
Like the US dollar.
The US dollar is the most common peg, yes. Examples like Tether, USDT, or USD Coin, USDC, aim to always be worth $1. They can also be pegged to other fiat currencies or even commodities like gold, though dollar-pegged are dominant.
But why have these if the whole point of crypto is often seen as moving away from traditional currency?
Well, they offer a kind of bridge. You get the benefits of blockchain like fast, cheap global transfers, 247 markets, but without the wild price swings you see with Bitcoin or Ethereum.
So practical uses.
Traders use them heavily to move in and out of volatile positions quickly without having to convert back to traditional money every time. Or people might hold them as a relatively safe place to park value within the crypto ecosystem, maybe to earn interest in DeFi protocols. They smooth out some of the friction between the old financial world and the new crypto one.
Okay, that gives us a much clearer map. The underlying tech, the main types of crypto, and these other digital assets like NFTs, DeFi tokens, and stablecoins. Now, for someone like Noah who's been trading, let's get practical. How do people actually get this stuff? And maybe more importantly, where you keep it safe?
Right. Acquisition and storage. The most common way for most people to get started is through cryptocurrency exchanges.
Like Coinbase, Binance, Kraken, those big names.
Exactly. These are online platforms where you can use your regular money, dollars, euros, pounds, to buy Bitcoin, Ethereum, and a whole range of other digital assets.
Kind of like an online stock brokerage, but for crypto?
Functionally, it feels similar for the user, yeah. You set up an account, deposit funds, place buy-sell orders.
Yeah.
Though it's crucial to remember the underlying assets, regulations, and risks are very, very different from traditional stocks.
Good point. Are there other ways besides exchanges?
Yes. This source mentions a few. We talked about mining or staking. That's how you could earn crypto by participating and secure the network. But that's generally more complex and requires technical know-how or significant investment, especially for beginners.
Right.
You can also earn crypto, maybe by participating in certain online activities, completing tasks on specific platforms, or increasingly receiving it as payment for goods or services.
Okay, so you've bought some crypto on an exchange or earned it somehow. Now, where does it go? The source talks about wallets.
Yes, and wallets are absolutely critical to understand because it's a common point of confusion, and getting it wrong can be disastrous.
How so?
Because your crypto wallet doesn't actually hold your coins or tokens in the way your physical wallet holds cash. The assets themselves always live on the blockchain, that public ledger.
Okay, so what is in the wallet then?
Your wallet holds your private keys.
Keys, like passwords.
Think of your private key as the secret cryptographic password that proves you own the assets associated with your public address on the blockchain. It's what authorizes you to send those assets to someone else. If you lose your private key,
You lose access to your crypto forever.
exactly. No central authority can recover it for you. It's ultimate ownership, but also ultimate responsibility. Your wallet is essentially a tool to manage these vital private keys.
Okay, that distinction is crucial. The wallet holds the keys, not the coins themselves. The coins are on the blockchain.
Precisely. And because security is so paramount, there are different types of wallets based on how those keys are stored. The source breaks it down into two main categories: hot wallets and cold wallets.
Hot and cold, what's the difference?
Hot wallets are connected to the internet. Think of the wallet integrated into the exchange where you bought your crypto, or mobile apps on your phone, or software wallets on your desktop computer.
Okay, so convenient for everyday use.
Very convenient to making frequent transactions, checking balances easily. But because they are connected to the internet, they are potentially more vulnerable to online threats like hacking, malware, phishing attacks.
Right, makes sense. So cold wallets are.
Cold wallets are the opposite. They are kept offline, disconnected from the internet. The most common type is a hardware wallet.
Those little USB drive looking things.
Exactly. Devices like Ledger or Trezor. They store your private keys securely offline within the device itself. Even when you use them to sign a transaction on your computer, the keys never leave the secure hardware. Paper wallets, literally printing out your keys, are another form of cold storage, though less user-friendly nowadays.
And the main advantage of cold storage is?
Security. Maximum security, especially for holding a larger amount or for long-term storage, what people call hodling. Since the keys are offline, they are immune to remote hacking attempts. For anyone holding significant value in crypto, using a hardware wallet is generally considered best practice.
That's a really important distinction for security. Okay, so we've laid the groundwork. The tech, the assets, how to get them, how to store them. Now, let's shift gears and really lean into what the source calls its deep dive perspective. This feels vital, especially for Noah, building on his 2 years of experience, the crucial considerations and, frankly, the risks.
Absolutely. This is where the rubber meets the road. Because while the technology is fascinating, the reality of investing and interacting with it is complex and, yes, risky.
And the very first point Katie's guide makes is simple, but maybe the most important: education first.
Non-negotiable. It says flat out, never invest money into something you don't fundamentally understand. And that's hard work in this space because it is complex.
Right.
Scams often prey on that lack of understanding, the FOMO, fear of missing out. Taking the time to learn the basics, like what we're covering today, before putting significant money in is just crucial.
And anyone involved for 2 years, like Noah, will have felt this one keenly. Volatility is real.
Oh boy, is it ever. Prices in the crypto market can swing wildly. Huge gains one day, massive drops the next, sometimes within hours. You absolutely have to be mentally and financially prepared for that kind of roller coaster ride.
Which leads directly to the next point: risk management.
Yes. Because of that volatility, the source is incredibly clear. Only invest capital you are genuinely 100% comfortable with losing entirely.
That
means do not use money you need for rent, for groceries, for your emergency fund, or for your core retirement savings. This should be treated as highly speculative capital if you choose to invest at all.
So it raises that question of how, or even if, these assets fit into a responsible, broader financial plan.
Exactly. And tied closely to managing financial risk is managing technical risk. Security is paramount.
We talked about wallets, but this goes deeper, right?
Much deeper. The source really hammers home the need for users to take personal responsibility for securing their assets properly.
Right.
It's not like forgetting your online banking password where you can just click forgot password. If you lose your private keys, or if they get stolen because your computer was hacked, or you fell for a phishing scam, that crypto is likely gone forever. There's no central help desk.
So what does proper security look like?
It means using strong, unique passwords for exchanges. enabling two-factor authentication everywhere possible, being incredibly wary of suspicious links or emails. And for storage, seriously considering hardware wallets. Crucially, it also means safeguarding your seed phrase or recovery phrase.
Ah, that list of words the wallet gives you when you set it up.
Yes, that phrase is the master backup for your private keys. If your hardware wallet breaks or gets lost, that seed phrase is the only way to recover your funds. You need to store it securely offline, never digitally, and never share it with anyone.
Got it. Handle that seed phrase like it's digital gold itself.
Pretty much.
Yeah.
Because hacks, scams, phishing, they are unfortunately common. User error and poor security practices are probably the biggest vulnerability for most people.
Okay. And given that the producer, Katie St. Ors, is a digital asset tax specialist, it's no surprise the source is emphatic about this next one. Tax implications are crucial.
Oh, this trips up so many people. It's a huge area of confusion and potential trouble. In the U.S., the IRS views cryptocurrency not as currency, like the dollar, but as property.
Like stocks or real estate.
Exactly. And that classification has major tax consequences. It means that pretty much any time you dispose of your crypto, it's potentially a taxable event.
Dispose of meaning selling it for cash.
Yeah, selling it for cash.
Yeah.
But also, crucially, swapping one cryptocurrency for another.
Wait, just trading Bitcoin for Ethereum, for instance, can trigger taxes.
Absolutely. The IRS views that as selling your Bitcoin, potentially realizing a capital gain or loss, and immediately using the proceeds to buy Ethereum. Each swap can be a taxable event.
Wow.
And also, using crypto to buy goods or services, buying a coffee, buying a car, that's also treated as selling the crypto at its current market value, which, again, triggers potential capital gains tax.
That sounds incredibly complex to track, especially for someone actively trading over 2 years like Noah.
It can become a nightmare without good records. That's why the source guide stresses keeping meticulous records of every single transaction. When you acquired it, its value at the time, when you sold or swapped it, its value then, any fees paid. This is vital for calculating gains or losses accurately and filing your taxes correctly to avoid penalties.
The transparency of the blockchain might make transactions traceable, but it sounds like it creates a huge burden for tax reporting compared to getting a simple statement from your stockbroker.
It certainly presents unique challenges, yes. Software can help, but careful record keeping is key. And related to managing this complexity within a financial plan, the source also advises on diversification.
Meaning don't put all your eggs in the crypto basket?
Precisely. If you do decide to invest in digital assets, it should likely be a small, speculative portion of a much broader, well-diversified investment portfolio that includes more traditional assets like stocks, bonds, and real estate. Don't bet the farm on crypto.
Sound advice. And the final few points from the source touch on the wider environment.
Yeah, things you can't directly control but need to be aware of. First, regulatory uncertainty.
The rules are still being written.
Exactly. Governments and regulators around the world are still figuring out how to classify and regulate digital assets. New laws or rulings can pop up and significantly impact the market, specific projects, or how you're allowed to interact with crypto. It's a moving target.
And that adds another layer of risk.
Definitely. Then there's the inherent complexity. We've touched on it, but understanding the underlying technology, evaluating the thousands of different projects out there, figuring out which ones have real potential versus which are just hype. It's challenging even for experts.
Which makes it easy to fall for.
Scams.
Yeah.
Unfortunately, yes. The space attracts fraudsters. You need to be incredibly vigilant. Projects promising unrealistic returns, fake giveaways, phishing links disguised as legitimate services, impersonators, they're everywhere.
So the mantra is,
do your own research, DYOR. Don't just rely on tips from anonymous people online or celebrity endorsements. Dig into the project, understand what it does, who's behind it, what the risks are. If something sounds too good to be true.
It probably is.
Almost certainly.
Wow, okay. That's a really sobering but absolutely essential list of considerations for anyone involved, especially someone like Noah, who's already active in the market.
It really is. Building that solid foundational knowledge, like what Katie's guide aims to provide, is the best defense against making costly mistakes and navigating these very real risks.
So quite a journey we've taken. We started with the bedrock technology, the blockchain.
The decentralized ledger.
Then explored the landscape of cryptocurrency itself, Bitcoin, Ethereum, altcoins, and broadened out to other digital assets like NFTs, DeFi tokens, Web3 assets, stablecoins.
Covered how you actually get them, through exchanges mainly, and the crucial difference between hot and cold wallets for storing those private keys.
And then, perhaps most importantly, we really dove into those critical risks and real-world considerations, the volatility, the absolute need for security, those complex tax implications, and the ever-present need for education and caution.
Absolutely.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.